Good afternoon, Governor. Good afternoon, members of the board, and everyone else who's here from the central bank. Once again, apologies for having to keep you waiting in the lobby for longer than you usually wait. We had an internal matter that we had to resolve. I'm not going into any depth in this, Governor, but you sent me a letter co-signed with the Secretary to the Ministry of Finance yesterday, essentially saying, look, we don't need to see you to discuss this matter. We are sending a written submission kind of thing, which is not acceptable to us, Governor. Nothing to do with you. But we will take necessary actions on that, having discussed it with the committee. We'll find a solution because we don't want to get into any ugly debate, but all of us want this country to do better, and so therefore we need to understand that there are certain roles and certain priorities, certain laws that govern everything, and Parliament is actually superior. And if Parliament requests a meeting with any official, it is the duty of that official to come here. And Governor, we appreciate, even though we sometimes throw curveballs at you, you have never missed a meeting. You're always here. If you're overseas, you request a different time. We honestly, sincerely appreciate it, right? But that doesn't seem to be the case with some other officials. We will have to deal with it outside of this. So therefore, the discussion we were going to have with the Treasury and the Central Bank will not happen today. It will happen at a later date. While we have accepted your letter, the 5-page letter, and we have no problems with that, your explanation, we have no problems. It is just that there has to be the courtesy extended to us as well to question the Treasury on matters that are important to the members of this committee. So therefore we will now, after we make the introductions for the record, continue with the second half of the discussion where we stopped, and then that will conclude the second point that we are expected to take up, that is the functions of the central bank as per Section 82A of the Central Bank of Sri Lanka Act. Is that okay, Governor?
That's good. I think we'll that on the basis for the letter is when your letter went to the Minister of Finance yesterday at a discussion with me. He was of the view that we have a very good coordination. Why don't we explain in writing to the committee the coordination mechanism? On that basis, I also agree, because it's not only from his side. We both sides coordinators are sending in writing what are the coordination mechanism in place under the law. So that's the purpose of the letter.
Yeah, I mean, see, Governor, you send a report to us also, but you still come here when we request you to come, because when you come, we discuss it and questions are asked and you answer them. So there is a communication here. I mean, sending a letter is okay, but that is, if we feel that we need to talk to them, then it is a courtesy extended towards Parliament for them to come. But let's take it separately. Thank you very much. Dr. Chandranath, will you start?
And honorable members, I'm Chandranath Amarasekara, Deputy Governor of the Central Bank and member of the Monetary Policy Board.
I'm KGP Srikumara, Deputy Governor and member of Monetary Policy Board.
Nandalal Veerasinghe, Governor, Central Bank of Sri Lanka.
Nihal Fonseca, member of Monetary Governing Board and member of the Monetary Policy Board.
Anusha Vijayasinghe, appointed member of the Governing Board and the Monetary Policy Board.
Nelumani Dawalagala, Senior Deputy Governor.
Tushni Virakon, appointed member, Monetary Policy Board.
Maitri Wickramasinghe, member Governing Board and member Monetary Policy Board.
Manil Jayasinghe, member Governing Board and member of the Monetary Policy Board. Ravi Ratnayaka, member Governing Board and member Monterey Police Board.
Vasant Alvis, Director Payments and Settlements.
Lasita Patberia, Director Economic Research.
Harish Chandra, Assistant Governor, Central Bank.
Dilrukshini Vatudura, Assistant Governor, Central Bank.
Inoka Wickramasinghe, Director Legal.
Of the central bank.
Sureka Kentawala, Additional Director, Bank Supervision.
I'm Rukshana Jayathilaka, Director of Bank Supervision. I'm Shanvi Jayasinghe, Director Non-Bank Supervision of the Central Bank.
Lasantha Sirimana, Chief Accountant. Hemantha Ekanaika, Director Communications.
Sudat Prasanna, Director Foreign Exchange, Central Bank.
Erantali Enage, Additional Secretary and Secretary to the Governor.
Jayodhanta Narayana, Deputy Director, Macroprudential Surveillance Department.
Sridharan, Additional Director, Macroprudential Surveillance Department of the Central Bank of Sri Lanka.
So let's get started from where we left off, gentlemen.
Good afternoon. Let me start the presentation on the central bank functions of the related to the financial sector stability. So before going to the detailed presentation, let me highlight the section in the Central Bank Act which was enacted September 2023. According to the section 82A of the Central Bank Act, the governor and the central bank or the members of the governing board and the monetary policy board and every deputy governors of the central bank shall, at the request of the parliament or any committee once in every 4 months, regarding the sort of discuss regarding the functions of the central bank. So actually this is related to today's the discussion, that's why we just highlighting that. And having said that, I like to move into the sort of the highlighting the governance structure of the central bank. This chart sort of high level discussing about or showing about the governance structure of the central bank under the 3 level. The first one is the policy level, and second one is the management level, and the third one is about the department level. In the policy level, as everyone knows that there are 2 committees governing, 2 board, governing board as well as monetary policy board. And in the policy level committees, there are 4 board subcommittees, audit committees, board risk oversight committees, ethics committees, and board human resources and remuneration committees. And under the other policy related committees, there are 2 committees in the central bank. One is monetary policy committee, other one is finance system stability committees, which are directly related to our core functions of the central bank. And if I move on to the management level, the governor, senior deputy governor, deputy governors and assistant governors are forming considered as a corporate management. And the corporate there's a committee called Corporate Management Committee, and under that there are other 6 committees in the central bank, which is sort of oversight committee.
So just 1 minute. So how many deputy? There's 1 senior deputy governor and 3 deputy governors. Is it? 2. 4 deputy governors. 2 altogether 3 deputy governors and assistant governors. So the 2, Mrs. Dowlagala and Dr. Chandrana. All right. Those are 3 deputy governors. And how many assistant governors?
We have 6 at the moment.
Is that the card?
We have, I think, card is about 8.
Okay.
Okay. And in the oversight level, there's a Information Technology Oversight Committee, Internal Investment Oversight Committee, Internal Reserve Oversight Committees, and EPF Investment Oversight Committee, and Non-Financial Risk Management Committee, as well as Financial Risk Management Committee. These are generally the risk management and fund management related aspect handling that. And there are some operational level committee as well. There are 4. And the third level is the department level. There are actually here highlighted 29 department, but the last year end public debt department was closed down since the function has been changed. Currently there are 28 level. This is the overall governance structure of the central bank. Having highlighting it, I just wanted to highlight other things. The primary objective of the central bank is achieve and maintain the domestic price stability. The functions related to this objective have been discussed last February. So today's presentation we are going to mainly focus on the functions related to secure the financial system stability. So before going to the detailed functions, I like to sort of highlight some legal aspects related to this financial system stability related. As in terms of section 6(2) of the Central Bank Act, other objective of the central bank shall be secure the financial system stability. It is one of the core objective of the central bank. And under section 7(1) of the Central Bank Act, there are duties, function of the central bank in related to the financial system stabilities, where the register, license, regulate and supervise the financial institutions, resolve the financial institution regulated and supervised by the central bank, adopt and implement the microprudential policy measures, which I will discuss in the next slide in a detailed manner, and the administrator supervise and regulate the payment system and ensure the safety, effectiveness, efficiency of such payment system, and establish the deposit insurance and liquidity support schemes as mean of securing the financial system stability, and finally promote the financial inclusion in Sri Lanka. These are some of the the legal aspect related to the financial system stability connected to the central bank. And if I talk something more about the financial microprudential authority in Sri Lanka, under the new Central Bank or Central Bank Act, Central Bank has been designated as a microprudential authority, under which Central Bank shall develop, periodically update overall approach to use the macroprudential tools and publish such approach with a view to informing the public of the role of the central bank in the macroprudential policy.
Just 1 minute. When you say macroprudential authority, you mean, that's not a defined term as a macroprudential authority. That is, the authority is with the central bank. That's what you mean.
Yes.
Yeah.
It's a power, and when we are regulating the financial institution, it can be from the overall system wide as well as micro level, and this macroprudential authority giving the powers to supervise.
Now with the microfinance law having been sort of now coming into effect as of sometime now, how does that get included in your sort of macroprudential and financial system stability aspect? Will you talk about it later at some point?
Yes, we will discuss that finance combination and the financial regulations.
If I may clarify, Honorable Chairman, the macroprudential authority is overall macroprudential side, which covers not only the micro-regulation by us, bank and banks, but also covers the SEC, other financial market regulators, insurance, as well as any other regulator supervising the financial sector. Macroprudential authority can cover that also if there's a macro systemic stability concern is there. This overall responsibility is to look at the systemic impact and concern out of the each and every regulatory authority, not the micro regulation is by SEC, by stock market, the insurance players by the regulatory authority, we banks and non-bank. As you said, credit regulatory authority will look at the microfinance and credit regulation. So we come in on much broader kind of umbrella on an overall system stability point of view.
To achieve the main thing, there are some intermediate macroprudential objective which central bank has to achieve to maintain the financial system stability, and in a, so the central bank to maintain the resilience of the financial system in a manner that support the provision of financial services even under adverse economic and financial conditions. That is the first one. And the second one, to contain the risk from unsustainable increase in credit and leverage. And as a third, to contain risk from the interconnectedness within the financial system and control the risk of failure of individual systemically important institutions. These are the three intermediate objectives as a macroprudential authority central bank has to carry out.
So is there some way of measuring systemically important institutions? And if so, how do you do that? And in this current situation, does it fall under any of these?
I think from our regulatory authority, I think macroprudential authority designate what they call
5 banks.
5 banks have been systemically important banks. That
5
we have
banks?
5 banks.
Two
state banks and commercial, Sampath and HNB. Those are the systemically important banks based on criteria.
Can I ask one question on the duties and the function? The first page, so it says financial institutions. Now, do we have a broader definition of what do we mean by that? Because there are multiple types of products and services that comes up, like fintech and various institutions engage in various forms of transactions and deposits and lending. So how do we define the boundary that comes under this?
In the microprudential approach, which is traditional, there are certain institutions that are directly coming under the purview of the central bank, for example, banks and finance companies and so on. But when it comes to macroprudential authority, the financial institutions are defined in the Central Bank Act, which goes beyond those traditional institutions that are directly under the central bank. As Governor mentioned, there are several other categories of institutions which are included in the definition, which is they are in the Central Bank Act.
I was actually referring to the objectives and duties of function by the previous slide. It says, it refers to register, license, regulate, supervise financial institutions, right? So that's why I'm trying to understand the scope, like when you do register, license, regulate and supervise, is it the list of agreed institutions, or are we looking at the impact of new institutions and new models that can impact the financial system? Like, do we have a way of bringing them in or taking them out? Who's deciding on this?
Generally, that happens within the scope given by the law. There are different statutes that are being administered by the central bank. Under them, there are different categories of institutions coming within the regulatory scope. And with regard to identification of new institutions, probably central bank may, at its own initiative or at the several other governmental kind of measures, maybe they are to identify institutions. For example, we were discussing microfinance institutions, which are not traditionally under the central bank's purview. But later, there was this thinking that those need to be also regulated.
So that came through a process, no? That came through a debate, discussion, problem. But now, for example, we are seeing buy now, pay later, right? It's building its capacities, like the fintech products that are growing, and probably taking the total finance system out of the original banking system out. So the quantum of those transactions are what should constitute whether we should have a view or not. Isn't that the case? Or do we wait till like something comes up as as a significant institution and then we look into how to monitor it? Or are we like really looking at the market and seeing where the transactions are going, how the transactions are happening? And do we have a way of identifying what kind of institutions that we should regulate?
Generally, in addition to the institutions that are within our purview under statutory provisions, in the kind of work of the macroprudential supervision department, for example, if they identify that a particular sector or particular set of participants are posing a risk, then the central bank can make recommendations to bring them within the regulatory purview and licensing regime. For example, now starting from traditional banking institutions and non-banking regulations. Now, recently we have wanted all money value transfer service providers to be registered. Right? Likewise, it is an evolving process where the central bank plays a major role by identifying. But it's, since it's a statutory authority, licensing can be done only within that authority. If that power is not there in a particular statute, that has to be enacted, and that power needs to be given to a proper authority.
So it's the duty of the central bank to recommend and suggest to build act. So how does that
duty, but if it poses a risk, central bank would certainly.
Who would judge that?
This is ideally if there's a systemic risk. For example, now even for example real estate, there's a real estate boom or something, then we have the authority to identify and raise that concern, and if that is going to have a risk on the financial stability.
So there's a research team that looks at
of
how
course,
it happens, right?
In the macroprudential authority, we sometimes basically one example is that we have now working with the condominium authority.
Right.
And we have summoned them and asking them whether there's any risk of real estate kind of a thing happening.
Bubble
happening. And also we looked at the kind of a gold loans, vehicle loans. If those are going to pose a risk to the system, then this department collect information and see whether there's a risk, to do some research and recommend to the relevant regulatory authority to take certain actions.
So as the markets develop and change, you guys can pick and choose what, like.
This is mainly we are not looking at on the transaction basis.
Right.
We are looking at whether there's going to pose a systemic risk. That is where the overall macroprudential means overall macroprudential risk that we have to manage. It's not the institution wise one is failing that every day that small one closing, opening. That's not our business.
To make a small correction, when it comes to financial institution, it would generally mean those who are generally coming under central bank by way of any statutory provision. But the broader section that I was referring to is recognized as financial sector participants. Right. That goes beyond the traditional institutions that come within the central bank.
Also, generally speaking, I think our regulatory oversight is strong on deposit-taking institutions, generally. That because we are basically more concerned in preserving the deposits. So banks, non-banks, and then the payment systems. So those, but under the macroprudential, we can bring in other aspects of finance, exposures and all of that. And either if we have the power to take action under the law, we can do it, or we can recommend it to whoever is empowered to other regulators or other authorities to actually recommend various actions to be taken.
You talked about contain the risk from unsustainable increase in credit and leverage as your third point, second most important. You see, when we stopped last time, we abruptly stopped at the point where we were going to go into a discussion on credit growth, both with licensed commercial banks and finance companies, etc. We were looking at sort of thematic areas and products as to what the status quo was. I don't know whether the committee wants to get a sense of that. I think it was Honorable Chaturanga that was most interested in that. If that is still a need, we can, if they are willing to. If not, we can continue. Because something we wanted to know was how credit was growing.
There are some slides we are discussing.
It's coming up?
Yeah.
Okay.
And based on this, the legal functions and duties, the central bank has implemented policies and regulatory measures to secure the financial system stability. Let me start with the banking sector. the last year in 2025, the bank supervision department, which supervises the licensed banks, issued different directions and circulars. If I list on that, actually the addendum to the Banking Act Direction number 5 of 2024 on the corporate governance, and then amendments to the Banking Act Determination number 4 of 2024 on approved securities accommodation granted to related party. This is related to the related party one. And the third one is with a view to strengthen the operational resilience of the licensed bank, circular number 2 of 2025 on reporting of information technology and cyber security events of the licensed bank was issued. Actually, this is also in 2025. And then the Banking Act directions on the recovery plan for licensed bank was issued. And then amendments to the circular number 3 of 2024 on guideline of establishment of mobile banking unit of the licensed bank was issued. And then actually other one is the framework on the banking sector consolidation with a view to establish a strong and soundness banking sector. This is for the banks. It has been, the framework has been issued. And then finally a circular in the last year end, a circular on the relief measures to assist individual and business affected by the recent cyclone effect, a disaster. A circular was issued. So these are the actions, of course, taken, a sort of issue directions and circulars issued by the Bank Supervision Department. Not only that, actually with related to the banking sector, to enhance the macroprudential aspects, the last year there were 2 directions were issued by the central bank. First one, the governor has already mentioned that, of course, the revised existing framework for identifying the systemically important banks and issued the relevant directions and gazette. Under this, 5 banks has been designated as a systemically important banks, and for those banks the regulations has been sort of enhanced regulations was implemented, as well as some higher capital requirement was required by the particular 5 banks. And the second one is the LTV ratio on the loan facilities given to the motor vehicle, that also under the macroprudential framework or as a macroprudential tool the central bank issued. So these are the 2 macroprudential related things the central bank issued to contain the any possible systemic risk. So those are the things. And on top of that, the banking sector, of course, Bank Supervision Department conduct 17 statutory examination, 6 spot examination, and 15 AML CFT examination. So these are the sort of every year they are doing this examination, as well as in the payment and settlement side with related to the banking sector, they set the maximum transaction fee, reissue the directions related to that. Actually, having these are the things the central bank did the recent past on the with related to the banking sector. Based on that, we like to highlight some brief development in the banking sector. The first one, the gross loans and receivable. The growth of the gross loans and receivable of the banking sector significantly increased at end 2025, while the stage 3 loan ratio declined significantly. So we can see that the line, the blue color line, the growth was 21.4% at the end of last year. It's a year-on-year growth. And the meantime, the stage 3 loan ratio declined to 9.7% level. And if we see the profitability ratios, ROE and ROA of the sector decline at end 2025 compared to 2024. You can see in the chart. And the capital adequacy ratio, of course, CAR of the banking sector remain well above the minimum requirement despite decline at the 2025 compared to the 2024. This decline also actually whenever the banks expand the credit, based on that risk weights will increase. So that's why the sort of small decline was observed in 2025. And liquidity position. Yeah, return on equity, return on assets. And if we talk about the liquidity position, of course the liquidity as measured by the LCR, liquidity coverage ratio, which is well above the minimum requirement. All currency LCR was sort of 249%, whereas minimum requirement is 100.
Perhaps you can explain that a little bit more to the non-economist so that we get a better understanding.
About the liquidity ratio.
Yeah.
Yeah. Actually, the liquidity ratio earlier we had the liquidity cover. Actually, for the liquidity coverage ratio, all the banks has to maintain certain level of liquidity to meet their obligations. So they are just sort of calculating. So for example, for a next 1 month period, what is the outflow they are having, the projected outflow, and based on that they are just calculating inflow as well in the stress condition, and then based on the net flow they may have to have the high quality liquid assets. High quality liquid asset means cash in hands and treasury bills, treasury bonds. Likewise, the high quality liquid assets they have to calculate. This high quality liquid asset should be more than 100%. So they have
more than 100% off
the 1 month net cash outflow. So always they must have the 1 month projected cash outflow, net cash. So this is the way they are calculating. Actually, minimum requirement is 100%, but they are having, of course, 249.
Yeah, on that aspect, does it mean the banking sector is so risk averse and not investing in assets that generate income or long-term projects? What does it mean?
This is a liquidity requirement. So it basically, when you look at the investment opportunity, why this high ratio reflects mainly the government banks are investing in government securities.
Yeah, now less opportunity now.
Yeah, then you can see it probably coming down over a period of time. What we say here, new requirement is that in an event of liquidity outflow, at least they need to be ready with certain amount of liquidity if there's a need for people asking deposits and all this thing. That is a precautionary, but they are maintaining more than that, mainly because of the classification includes government securities. Usually all the banks, one of the major investment is because of the government right large fiscal deficit issuing all the every time. Basically banks are financing the government operation.
I mean, that goes to the core of this whole growth issue, no? I mean, whether financing is available and affordable to the regular small industrialist or whatever, right? I mean, this shows like the Honorable Minister mentions.
They are risk averse because they are depositing at 7% or 8% on government bonds, right? So that's the return they would get now.
No, it's treasury bonds is about 10-11%.
So they're getting a super return for no risk?
No, I mean, when you look at now with the fiscal consolidation, you can see overall exposure to public sector is now coming down, so private sector is now shifting the other way. That is a positive side of fiscal consolidation. The government is demanding less from the market, and banks are now lending more to the private sector.
No, they do. But the current status is there's a high liquidity, no? At the moment. So there's a 249%. How do you define it? 249 points opposed to 100.
Or liquidity ratio, yes.
Yeah, in that what you're saying is a larger portion can be government treasuries.
Correct. They have been carrying a stock of government treasuries over a period.
Governor, the previous time you came to talk to us on this, you had a slide on the public sector credit versus private sector credit.
That's a chart.
Percentage of GDP. Somehow it is not in not this presentation. This is a truncated one, no?
Yeah.
The previous one.
Yeah, previous one.
So that is what I was asking the question earlier.
Yeah.
That credit expansion, where is this credit going to? I mean, if it is going to government corporations. No. It was not, I mean, it was there. That is what I was asking earlier. Whether
we said the credit growth was on 3 areas. On bank, on pawning, on leasing and the
Given this discussion,
And one other
do you have those slides? It is in that non-truncated one. It is slide number.
Honorable Chair, we have those slides. The Director of Economic Research has got those slides. We can, after this presentation, we can go into detail.
Yeah, okay. So that's just one section of credit growth. So these answers to these questions are actually in those slides. Okay, please go ahead.
Then if I move into the finance company sector,
the regulations and measures of financial stability. One thing is that now we did have 2 development banks or 3, and they still carry the name of development banks, but operating as a commercial bank. Isn't that a distortion, or how do you look at it?
They don't have the word development anymore, right?
They do.
Why? DFCC Bank used to be called Development Finance Corporation of Ceylon, DFCC. Now it is DFCC Bank. It doesn't have development, it's a name anymore. Also NDB Bank. This used to be National Development Bank.
So now what?
Now it's NDB Bank.
Yeah.
RDB, I don't know about RDB, but DFCC and NDB doesn't have the
So
word
they don't
development.
use a lengthier word, like it's
No,
just
no.
use 2 initials only.
No, it's just a branding, because I was there at that bank at the
I
time
know.
this changed. Development Bank, Development Finance Corporation of Ceylon, Mr. Prelis made it DFCC Bank. I mean, there's reasons for that. I mean, we can get into it at some later point. Professor Dunu Singh is there. I think he's been talking about these things from an academic angle for a long period of time. The need for
Because
development
there's
banks.
need to be a very prominent presence given to development banks in this country, and it has not been a discussion thus far. So
I mean, there are senior bankers like Mr. Fonseca, who's run banks all his life. The point is, where is long-term financing? that
No,
I think
I
is
don't
the
want to
issue.
get into that. I just want to ask about, there's a distinction between a commercial bank and a development bank. No? So when in perceived manner, when you carry a development bank tagline and do commercial banking, the consumers can also get confused.
No, at the moment, DFCC and NDB doesn't carry a development bank tagline. Only I think RDB goes as regional development bank, I think, and they're and also depends on what you talk about. Development banking in the traditional sense was giving long-term finance, basically.
Project finance.
For project finance but now every commercial bank does it. In the sense that obviously the big difference is development banks elsewhere are not dependent on public deposits.
Yeah.
The problem is, moment you start taking public deposits, the regulatory regime changes, and so
That's
that
right.
is a matter
So it
for
becomes a
government
commercial
to.
bank.
That is a matter for government to resolve. In the sense of how to fund it. How to provide the
I'm
funding.
not getting there. I'm just saying that these names.
No, different banks are necessary. I'm not arguing with the fact that development banks are not necessary.
Yeah.
They are.
If you go back to the event, most of you obviously recall in '96 when Madam Chandrika, had a deal with the World Bank and the ADB to restructure People's Bank and Bank of Ceylon, and she reneged on that. And the long-term credit lines got pulled out of DFCC and NDB. And I recall very well, because I was the treasurer of DFCC Bank, and how overnight market went up to 104% that one day. And from that point on, treasuries had to be created at DFCC and NDB, and they started to Mr. Fonseca, I remember very well, I guess, started to. You would lend to me, no? You lent to me. Then I turned around and lent to you at 80%, right? But the point is then, Honorable Minister, we had to start collecting deposits because we had lost the tag of a low-income country. when we graduated to a middle income country, those credit lines were lost.
But I think still there is low cost funds if you really look at it.
Yeah, there
there
is
is
portion of development
financing left in the world.
Even for Ditwa, there was some sort of a...
And now what has happened, I'll tell you, now what has happened, the Treasury has become the development bank. Now Treasury is lending commercial banks at 5% or 0%. Now, if you really take 95 billion a year, you could have a development bank.
Right? I mean, I think it's not...
So what's happening now is, we are expecting commercial banks to do it, but then the government has become the development bank.
No, but then where is the Treasury getting long-term financing? No, but where? Treasury doesn't have long-term financing.
Treasury already allocates development finance.
My question is, Madam, where is the money to the Treasury? Where is the Treasury getting money from? Treasury has Treasury bills and Treasury bonds. So they perhaps can raise 30-year money, but I don't know how much 30-year money they raise, or 10-year money for that.
I think what the Deputy Minister is trying to say is, I think there was an allocation of 90 billion for which could have gone to a development bank, but it's actually going to commercial banks.
Can we look at it this way? What percent of lending is long term from your perspective, from central bank perspective?
Sorry? But while you answer, I would like an answer to the question from the members. What is this long-term lending by the Treasury to commercial banks? What is that
about?
Not
long-term. It's basically this low-interest schemes, no? So they route it through the commercial banks.
So I think the difference between, to me, development banking means not just the rate, but the tenor. Like, can you get 10-year money?
Yeah.
Development banks, development financing requires long-term facilities. And I think that is where the banks are stuck.
That's one, Harsha. That's then how you also look at the project also. Right?
Yes, that's true.
So
100%
now
agree with
this
you
is
on that.
You are using government low cost interest, and you are taking
but
collateral.
If the government gives the fund,
and
they can
you are taking a 3% profit over
what
it.
they are giving for.
Right.
No,
so
but then if they give the money, they can prescribe and say, "This is our money. Give it at this period for this tenure."
Who? The government.
The government.
Yeah, government can do that.
Yeah, so that's limited to the level of what the government gives.
Perhaps
if you look at
this
the other
good
question,
to intervene at this point and show us what is being lent. Is that what you're going to do, Doctor?
No, Harsha, we asked a question.
Yeah.
So get the answer on that. What percentage is long-term lending in our lending portfolio?
Yeah, so it is in that three
I
slides.
think they will
if we can
present
go to
on
those
it.
3 slides, Honorable Minister.
Yeah, two
if
more
we can-
quick questions. Just hold on. On the LTV, loan to value ratio. So early we used LTV also to drive behavior. For example, we promoted electric vehicles versus the fossil fuel, right? So now we've made the LTV equal for any vehicle. Now we are not driving behavior. So just want to understand what is the basis that why we moved from a policy driven LTV to a very technical finance level LTV. Early the electric vehicles could get up to 90%, 80%. Now the petrol vehicles also get a 50% and electric vehicles also get a 50%, if I can remember. So how does this LTV policy changed in the central bank?
Yeah, LTV policy changed with the Central Bank Act with the macroprudential authority. Loan to value ratio is a macroprudential instrument to address the risk of a financial institution facing when they are lending.
Okay.
So if the risk is higher, then we impose loan to value ratio. Say, for example, lending to gold, if that is more than the motor vehicles. If you see there's a risk of lending, loan to value ratio is too high, and there's a possibility risk of value coming down, then it's a risk for this financial institution.
Right.
This is for that purpose.
So earlier that was not looked at, what you're saying.
That the earlier macroprudential authority.
So from a financial stability perspective, this is the right thing to do.
This is the right thing to do. For the incentivize, there are different instruments. Right. Can have different taxation. All these things can incentivize industry-wise, production. That's not the macroprudential instrument.
Yeah, and on the last point, I know this is a controversial topic on the banking payment systems, right? So payment systems are tech driven, right? So you basically have a running cost, more or less a fixed cost. It's not a variable cost, to my knowledge, right? Because when you do transactions physically, you need to have more people, more paper, all that things. So if a transaction software handles 1 million transactions to 10 million transactions, there is no significant incremental cost. But we still allow banks to charge 30 rupees, 50 rupees on digital transactions. That's absolutely irrational. How do you really explain that?
Banks system is one thing. Banks need to ensure proper cybersecurity system upgraded. Without that, there will be a lot of scams.
Yes.
That is where it's not only initial cost of the capital, there's a continuous maintenance of
Agree.
systems have significant cost to the banks.
But I'm saying that is not incremental.
No,
that is not
for
the
example,
variable
if
part.
you buy a bank or core banking system and maintain that maintenance cost for 5 years is more than the initial cost. If you look at the maintenance of those systems.
No, we
even
want,
RTGS, I mean, I can.
So then Governor, then the thing is, at the current digital penetration level, banks should be making losses on digital transactions.
Now, online,
when we promote digital transactions, say the entire country goes into digital transactions versus 30% of the country is in digital transactions, still banks maintain all these risk concerns and all that with 30%. Now, when we promote people to go digital, and when they go 100%, there's a super profit to the bank. How do you look at that regulation?
I'm not quite sure why. If they expand
what I'm saying is the incremental cost of security on a technological platform is not dependent on number of transactions. So when the country moves beyond a particular threshold,
there's a point. If the volume is higher, you can reduce the cost. That's correct.
Honorable Mr.
So do we have a view on that? Now, for example, what I'm trying to say is 2 years ago, what was the volume of digital transactions? Still Commercial Bank, Bank of Ceylon had a very good, robust digital systems, right? Sampath Bank, all those things. Now 2 years down the line, the digital penetration has increased. It will increase another few years. Would the 30 rupee come down? You had to force it this time.
Yeah. There is a gentleman at the back. Yeah, please.
Honorable Minister, you are correct. So what your argument is correct, but it is not uniform across all the banks. So so what we have done is we did the analysis and we brought down 30 rupee, what was there earlier as 30 rupees to 25 rupees. Now it goes as 25 rupees. When we bring it down to 25 rupees also, most of the banks, especially the small and the medium banks, came up with the same argument that the governor has mentioned now. To maintain their systems, they want to recover the cost for that. So there is still the cost. So although 1 or 2 banks, you are correctly said, yes, they are making a profit, but still the majority is not that. So we have to look at the overall system stability, and each and every bank should be strengthened because the weakest link is the most issue here. So we have to give some sort of a facility for them to strengthen their system. So because of that, this cost is there. Still, we will now, we did it 2025 beginning, we brought it down. So after 2 years time, we will analyze it again and see how far we can go down.
Agree. I completely agree with you because there should be thresholds to it. Then when you say a smaller bank who's doing 1 million transactions, it's 35 rupees. Agree. When they cross to 20 million, it should come down to 25. So we can have a framework that ensures that, when the digital penetration increases, there's no transaction cost at all in the future. We have to get there. We can't keep the government forcing to remove the QR code price. We want one side drive digital and other side we are allowing banks to charge 25 rupees, 30 rupees out of every digital transaction. So what I'm trying to say is, say that you have 15 license bank. Most of them are digital now, right? I think all of them. And the ones who has the lowest volume, they can go up to 50 rupees. That's okay. So that's their job. And the ones who have cost threshold, you can be at 30 rupees. Ones who have flying with digital, they can bring out to 10 rupees. So we don't necessarily need to have a one rate for everyone. That's what I'm saying. So based on the volume, you can have, you can guide them to have a reasonable rate.
Yeah, so what we have done is we have removed the disparity. Earlier, for a particular transaction, for example, to pay for the Inland Revenue Department and the customs, the price was 50 rupees. So that was brought down to 25 rupees. Now even 1 billion also can be transferred at a rate of 25 rupees. So that is how the money is transferred to Inland Revenue Departments and customs. So at the moment we have brought down prices as far as possible, but again we will do another review and we will see again the cost structures, because even before when we bringing down the prices, we collected the cost structures. So based on the cost structures, we have looked at how far the prices can go down. So in most of the banks, the prices, at the moment the price that we have given is the break-even price. So that is how we have determined the price.
Okay, thank you.
I think it's a very useful conversation here, because the objective is to bring down transaction cost, and by introducing technology, if that is supposed to happen and not happening, then that goes as profits
Because
to somebody
if I
else.
go to the bank, I have
And
no cost.
I may also add,
Yeah.
when you refer to the digital transaction, there are different types of transaction. I think that's why when you look at the pricing, there are RTGS, interbank SWIFT transaction, and so QR codes. Different pricing for depending on the cost of the transaction. It's not everything as priced.
Governor,
the same.
bank to bank, my account to another account in the same bank, or a different bank, there's a charge, right? So that's, yeah.
That's way charge. I don't think this can't, if they ask them to do it free, they will not invest in the system, there are risks to
No, what I'm
money.
saying is not free, it has to gradually come down.
So, and also in the ATM, fees also, because their problem is transport cost for loading cash is huge.
It also means tested, no, Honorable Minister. When you have a lot of money, they charge you a lot.